Trading can be tough when the market is very volatile. So our guest today is talking about how to manage your emotions and still stay consistent in your trading during those times. Pratik Patel is here. So Pratik, so how do I manage my emotions when it seems like there's chaos in the market and the volatility is really high?
When volatility is high, one way I like to look at volatility is looking at the volatility index. It gives me a measure of how much volatility is in there, the volume, the movements in the market. So me going into each trading day, knowing that today is going to be a volatile day, it looks very volatile, what I like to do is remain patient, remain calm. One thing a trader can do approaching this volatile market is control yourself. You can't control the market. It's the best thing to control yourself and control your emotions. Knowing that it's a given that markets are volatile, so you have to approach it very patiently, and also you have to approach it confidently, knowing that I have to control myself. So one thing I like to do is wait out, the first 30-40 minutes of trading, let the volatility do its thing. If there's still continuous volatility throughout the day, I'll just call it a day. I won't even trade. And once I'm in a trade, what I'll do is keep a stop. A stop is the best way to control that volatility, control that movement in the market, because it's going to keep you protected no matter what. If the market all of a sudden turns against you, you're protected. You're not scrambling to cover. You're not panicking. You're not getting that over-analysis phase. You know that you kept your stop at a given point, and if you're wrong, you're wrong. The market hits it, and you're done for the day or done for that trade. And then, keeping stops is the best way to control your emotions and trading day to day on day trading.
Now, at the same time, we all want volatility in the market, right?
Correct.
We need movement, but is it more experienced traders that should really be trading when there's a tremendous amount of movement, where we're way outside of the normal range of movement in a particular sector, or should a beginner, is that a good time to learn too?
Well, the thing about volatility, every trader wants it because it gives you the big movement, but you want consistency. If you're going to see volatility day in and day out, every single day, then it's going to be consistent, and that's how you can approach the market with your trading strategy. It's going to be consistently volatile every single day. That's what I'm going to do. But recently you're having one day volatility, next day it dries up, next day volatility, 2 days in a row, the next day dries up. So you're getting a lot of chop and a lot of confusion in the market, so you don't know what to expect. Sometimes you might have volatility spike in all of a sudden for an hour, some news from overseas or something happen with the Federal Reserve or some kind of interest policy. So volatility is very important. If you want to trade volatile markets, you want to see it consistently happening every single day, so you know what to expect coming into the trading day, and you can adjust your stops, your entries, and your exits accordingly, versus it just being a surprise every single day.
If one market is particularly volatile, say the oil market or commodities, should I be able to then switch over to just trading equities that may be a little more calm that day?
Well, you don't want to keep switching what you're trading. If you're very consistent with trading one market, for example, the oil, if you've been trading it for many days, many weeks, many months, and that's the market you trade, there's no reason just to abandon ship just because it got volatile. Wait it out, because volatility is not going to last forever. Volatility will die down. And in the case, if volatility is going to be very consistent every single day, then you have to approach it knowing I'm stepping into the trading day, knowing the market's going to be volatile. I need to either mitigate my risk by putting on less contracts, or manage your position a lot better by controlling your stops or using some kind of hedge. So I wouldn't recommend just abandoning that market just because it's volatile. Every market is going to get volatile at times, and I believe that's just the way markets work. Nothing's going to be steady every single day. Every market, either you're trading pork bellies, you're trading lean hogs, or you're trading the S&P index futures, there's going to be that spike in volatility. Nobody can avoid it. You just got to adapt to it and go with the flow.
Pratik, thanks for your time.
Thank you for having me.
You're watching the MoneyShow.com video network.